Today we look at 4 financial tasks you shouldn't put off, and what is the best ETF to get exposure to Mexico.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, June 5th, 2024 edition. I'm Justin Klein and joined today once again by Luke Guerrero. Thanks for being here, Luke.
Yeah, happy to be here.
And today is just a normal Wednesday. We had some economic news that came out today with a big jobs number on Friday, and we are going to discuss all of it as well as field many of your questions, both live and recorded. But this show is about you. It's a reminder that the path towards financial freedom is taken one step at a time. You won't get there in one day, 1 week, or even 1 year. But we can use this hour to give you the tools, the mindset, so you can make good decisions with your money consistently over time. Not making one good trade or buying one good company or one smart rebalance in your portfolio. It's about having the education, once again, the mindset to make these good decisions. Now, we will run down the market performance for today and the show topics that we will discuss. But as usual, we're going to tackle our first caller question now.
Hey, guys. Chuck from Clayton. Question on Unum Group. Whatever you can tell me about it, I appreciate it. Thanks.
All right. Unum Group. This is an insurance company, provides group and individual disability insurance and group life insurance, mainly here in the U.S. and the U.K. Insurance companies, they're not exciting. They're pretty boring, but they're great businesses typically. And this is one of those. About a little less than a 3% dividend yield. So I like that, he's not chasing the dividend here. What are you seeing on the profitability front for Unum, Luke?
Yeah, well, in terms of profitability, it looks like it's actually been improving over the past 3 years. Its return on assets is somewhere around, looks like 14%, which is pretty decent. Its return on invested capital somewhere around 10%. It earned $6.50 a share last year. It's improving upon that. It's supposed to make $8.23 this year and $8.73 next year. So certainly the profitability, as well as their cash flow, is on the right track. Also of note, they've been buying back shares pretty consistently over the past 5 years, which, as you all know, is something that we like. So on a high level, fundamentally, it looks like a pretty solidly run company on the right track. Yeah,
and that's what's interesting here. You talked about the buying back shares. And I also said this is a slow grower. That's typically the case for these insurance companies. There's nothing exciting about it. But if you look at earnings per share, it's gone from $4.29 in 2017 all the way to expected $8.72 next year. But if you look at total net income, it's actually down a bit from 2022. So what you're seeing here is the share buybacks are bringing that earnings per share higher. So that's what's driving it. But they can certainly continue to do that share buyback because their free cash flow is very robust, about $1.2 billion trailing 12 months and a $982 billion market cap. I like it. Now, near term, it's kind of getting choppy, and recent earnings estimates for next year are coming down, but it's a quality business. If you're looking for an insurance name, this is a solid one for you. But once again, not super exciting. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point concerns this story. 4 financial tasks you shouldn't put off. So we'll run down some common financial pain points that many people they don't want to face, and we'll cover those along with a few other topics. One is in regards to the economic data as of late. We have the jobs number on Friday. We had the ADP number today, and there is growing collection of data that the consumer is slowing, that the economy is slowing. Now, does it mean there's a recession? No, but that maybe we're taking another stair step down, really feeling the rate hikes that we saw in 2022 and 2023. So we'll take a look at that. Also, the dollar is near record highs. I'll say near. In inflation-adjusted terms, it's about 10% off from its all-time high. But we're going to look at what that means for the global economy and ultimately earnings. And then if we have time, we'll touch on how private equity has touched the healthcare business and pushed up costs in a big, big way. So those are the topics on the docket for us today, as well as your voice bank questions. One is on an ETF, FTLMX. It's a Franklin target dated fund, and then converting Roth 401k to a Roth IRA. We have a call on that. And then, of course, comments that came in via our YouTube channel and questions coming from there. So we'll look at that. And, of course, we welcome your finance and investment questions now at 888-99-CHART. We're going to head into a short break, and on the other side, we'll talk about today's market activity and take your questions on the InvestTalk Anytime listener line at 888-99-CHART. Hey, InvestTalk community. Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Now, Luke, let's take a look at the market today. It was a decidedly positive day overall. Why don't you talk a bit about the ADP number that came out and maybe what drove the market higher today?
Yeah, well, there are a couple of things that were driving the market higher. NVIDIA has been driving the market higher for some time now. It continued to do so today as well. Softer ADP private payrolls was the latest sign of kind of the slowing growth backdrop. ISM services actually surprised to the upside. So that was some positive news. I think one of the big headlines is that the Bank of Canada became the first G7 country to cut rates today. And a survey of economists think now that the Fed will cut rates as many as 2 times starting in September. So on the heels of the first interest rate cut of the major nations, I think the market took that as a sign that maybe we can expect the same thing in the U.S. Sooner rather than later. I don't know if that's what that means, but that could be what the market is interpreting here.
Yeah, I think the beginning of the realization that the expectations for rate cuts this year are starting to turn the other way. As we moved into 2024, the market had priced in, was it 6 to 7 rate cuts on the year? And we said then that was far too optimistic. The economic numbers were just a bit too strong to allow for the vast majority of meetings this year to include a rate cut. But now you're starting to see a bit of that weakness as we head towards the end of the first half of the year. And we know that the market loves that. The market loves the potential for the Fed to cut rates and an easing cycle to begin after a somewhat historic tightening cycle that we saw just a couple of years ago. So yeah, I think that's the main reason. It's one of those bad news is good news type of stories, and we'll get more color on that tomorrow on Friday with the jobs number. And we did get GameStop that was up 19% today, AMC 7.5%, AMD was up almost 4%, like you said, NVIDIA up about 5%. So a lot of those retail sexy names certainly had a good day today, and that drove the market higher. Now let's keep things moving and go back to the InvestTalk voice bank. This came in earlier on 888-99-CHART.
Hi, I was calling about the Franklin FTSE Mexico ETF, ticker symbol FLMX at Foxtrot Lima Mike X-ray. I was calling just to see what y'all thought of the fund, if it was a good play on Mexico. I'm kind of targeting Mexico and India as my two emerging market funds to diversify with internationally. And I noticed that this one had a pretty low expense ratio of 0.19. I was just calling to see what you guys thought about it and if you guys thought it was a good ETF to invest in. Thanks a lot for everything you guys do. I love the show. Take care.
Appreciate that. Now, this is the Franklin, it's FLMX. This is the Franklin Mexico ETF. And there's also the iShares Mexico ETF. That's EWW. That has a 50 basis point expense ratio. So, the fact that this is noticeably cheaper, that's pretty interesting to me. Anything jump out at you, Luke?
I think it's pretty well diversified across the size spectrum. It's about 50% large caps, which is slightly more than the index overall. The mid caps, it's about 30%. You get some small cap exposure, though, albeit pretty small. Overall, I think it's a pretty decent fund. It seems pretty in line with indices. Let me take a look at how it's constructed.
There's 38
what are
holdings.
You seeing while I take a look at that?
Yeah, I see 38 holdings, basic materials 16%, financial services 18%, industrials about 12.5%, and consumer defensive about 33%. And so I like this. I'm bullish on Mexico. It was interesting that Mexico had their election over the weekend, and you had the first female president being elected in Mexico history. And she is a protege of AMLO, the previous president. And, they have a very populist policy stance, their party does. And, I think that's why they got reelected. It was interesting to see the Mexican stocks sold off on Monday, but they've been rebounding pretty nicely yesterday and today. So, I like this. If you want broad-based exposure to Mexico, a 19 basis point fee is not too bad, in my mind.
Yeah, and I will add there's actually no small caps in here. They restrict small caps from this fund, and they have a capping methodology where they're not going to go full market cap weight on the largest names because they just for RIC compliance issues. So the effect of that is you essentially have overweighted mid-cap names. So you still tilt more towards the mid-caps than you normally would, but just keep in mind you don't get any small cap exposure in this fund.
Yeah, and we said many times, mid-cap is not a bad place to be from a risk-adjusted standpoint. And I like this. FLMX is the symbol. Now, if we move quickly, we can fit in another caller question now.
Hi, Dave from Ohio. And sorry to hear about Steve. I was calling in about a stock, Wendy's, the Wendy's company. It's fast food. The symbol is WEN. It's at a 52-week low, pays almost a 6% dividend. Your thoughts? Maybe that this is just a value trap. I'll be listening. Thanks.
Whenever I hear north of 5% dividend yield and at a 52-week low, I think of, yes, it's probably a value trap. And the first thing I always go to is how much debt do they have on their balance sheet. And this one has a decent amount considering its size, $3.5 billion market cap, about $2.75 billion in long-term debt. Does look like a fairly stretched balance sheet to me. 3.2 times interest earned. Not super low, but definitely not great either. What are you seeing, Luke? Is this a value trap or is it a great value?
I think there's too much debt on their balance sheet. Like you mentioned, their interest rate coverage ratio is not that bad. 3.05 is what I'm seeing, relatively the same thing. So they're not too highly levered. They do have some room to run there. But for me, it's a growth story too. Growth tapered off in 2021. 2022 saw a little bit, but it's been pretty stagnant for at least the past couple years. And their margins are decreasing as well. They made 9.4% net margin last year. That's set to be 8.9% this year. On an anecdotal note, I don't frequently hear people say when they want fast food, I'm going to Wendy's. Maybe that's just because we live in California with In-N-Out. But in terms of the brands, I've always felt that Wendy's had a weaker brand as well.
Yeah, I'm just going to go with the fact that, like you said, they have a lot of debt. They have a rough chart. And when you see these in long-term downtrends, you want a major reason, a major signal that there's a reversal before getting in, which would be, a giant reversal day on volume that everyone's kind of piling back in and things are changing with the company. And I'm not seeing that. So I would certainly pass on Wendy's. Now, we're moving into a break. I hope you can make time to sign up for the next InvestTalk Wealth webinar. It's coming up on Tuesday.
The big day is coming up fast. Click the link in this video to register for the new InvestTalk Wealth webinar. It's all happening online Tuesday, June 11th at 1 p.m. Pacific Time. You are invited to join KPP Financial's InvestTalk hosts, Justin Klein and Luke Guerrero, as they reveal the secrets of quality investing. Learn why it's essential to look beyond high dividend yields so you can build a resilient and profitable portfolio. In today's volatile market, quality investing is the key to long-term success. Justin and Luke will provide insights and strategies to help you make informed investment decisions. Reserve your spot now. Click the link in this video to register for the new InvestTalk Wealth webinar.
Now, our main focus point is about some simple financial tasks that often fall by the wayside, but they don't take long to deal with. But many people focus on other areas or just think it is too hard. Now, the first pain point is typically contributing to an IRA. A lot of people wait to the last minute and they try to get in the deadline. We have people call on tax day to try to get money into their IRA, and it just doesn't work like that. You can't get money moved that fast. So it's always important to put these things on autopilot, meaning I know we have a lot of clients that have their bank account connected to their IRA, and it just automatically pulls X amount from their bank account every single month on the same day, and that ultimately maxes out their contributions for the particular year or whatever they can afford. Very similar to what you do in a 401k. You can set it up that way. It just takes a little more work, and but I think that's a simple solution here that most people really overlook. Luke, why don't you talk about the second pain point?
Yeah, well, the second one is really converting your backdoor contributions to your Roth in a timely manner. And the issue here is that if you take too long because you're converting to the after-tax dollars, you could potentially increase your tax liabilities on any unforeseen gains, right? So here the tip would be to schedule your conversion close to the contribution time and add reminders to yourself to ensure timely execution, because again, you don't want to increase your tax liability when you're doing that conversion.
Yeah, because basically you contribute to an IRA, you invest it, it grows, and then you convert it, you're adding to that tax bill potentially. The number three is one that's very common, which is not investing your HSA assets. This is pretty wild, Luke. Just 1% of people with an HSA had parked their assets in anything other than cash. So 99% of people have their money in HSA, and they're not investing it. And that's one of the great features of an HSA. It's triple tax deferred. And it means that the contributions come in tax-free. Then growth of that money is also tax-free. And then the withdrawal for qualified healthcare expenses, also tax-free. So there's three ways there, and 99% of people are avoiding the middle one altogether. And a lot of people think, oh, I need it in cash in case I need to spend that money. But you kind of know, and these things are liquid, right? You put these, typically HSAs, your options are some sort of fund that you can invest in, and you can sell those and get that liquid pretty quickly. You don't need that money in there, or at least all of it, right? You keep maybe a bucket strategy where a small percentage, 5, 10, 15% is maybe in a cash-like instrument. The rest should be invested, though. So I think that is something that clearly too many people overlook. And then, Luke, why don't you cover the fourth one?
Yeah, certainly. Lastly, it's making sure that your beneficiary designations are up to date, because it's important. A lot of people don't realize that actually the beneficiary designations supersede wills, but oftentimes people don't change them just because of life circumstances. Maybe you go through a divorce, maybe you end up having kids and you want to make it your kids. And so it's important that maybe annually, maybe even semi-annually, but at least annually, or whenever there's a major life event, you just make sure that you double check that those beneficiary designations are exactly who you intend for them to be.
Yeah, and especially if you transfer your assets from one broker to another, that happens a lot, right? You don't like Fidelity, you move to Schwab or whatever, and you open up a new IRA and you don't give the proper beneficiary designation. So make sure you're keeping up to speed on that. And those are four that are very common, but very easy to remedy. Okay. Now let's swing back to the InvestTalk voice bank for a question that came in earlier from a listener in North Carolina.
Yes, Luke and Justin, thank you for taking my call. This is Josh in North Carolina. I've had some good luck lately investing in some agriculture sector stocks. I was looking at a company, FMC, Frank, Mary, Charlie. Last 2 years ago, I bought them when they were real high. They've come down a considerable amount. I wanted to increase my position. I did not know what you thought about this company, and if now was a good time to jump in. Thanks a lot.
Are looking at FMC. It's a pure play global crop protection company, and it's fairly large. It has a market cap of about $7.2 billion, so we call that a mid cap in our field. They do have some debt on their balance sheet, 4% dividend yield here, and it's certainly in a downtrend. It really has been since the beginning of 2013. What are you seeing, Luke?
Yeah, well, not only is their stock in a downtrend, their cash flow is in a pretty significant downtrend since at least the end of 2019, steady and then dropping off towards the end of 2023. Their debt load, that $4 billion on a $7 billion market cap, it isn't constraining them too much. Their times interest earned is about 3.43, so that's not too bad. They have about 7.5% short interest, so certainly a lot of people in the market think that it's a little bit overvalued. And it's worth noting that over the past year, it's dropped off about 50%, so it certainly is about the cheapest it's been in some time.
Well, that's because operating margins have dropped by about 50%. It peaked out around 23%. Now it's at 13%. Back in 2016, it actually had a negative operating margin for a brief period. So it certainly can get worse, and the chart is not looking great. So I wouldn't be owning this. If you own any, I would actually be selling it and moving on. Thanks for the call. Now, on the next Invest Talk, we'll look into this question. Could a value-added tax be a potential solution to our crippling debt problem? That story is tomorrow, but for now, I'm Justin Klein with Luke Guerrero, and we are ready to take your calls at 888-99-CHART. We're here to answer your finance and investment questions, so make sure you give us a call at 888-99-CHART.
Did you enjoy our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts and get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join the community of informed investors.
Hi, this is Dan from Walnut Creek, and I had a question about A.O. Smith Corporation, stock symbol AOS. I guess since about May 15th, it's been a little bit of a downward trend, and I just wanted to get you guys' opinion on it. I've got a very small position, and I've been looking for an opportunity to purchase some more, and I was wondering if this is a good time to do that. Thanks very much. Bye.
Are looking at AOS, which is A.O. Smith Corporation. This is a company we talked about in the past, about $12 billion market cap, so about a mid-cap name. And they make residential and commercial water heaters, and it's a wonderful business. They operate a wonderful business, a very low debt, actually net cash in their balance sheet, return on equity around 31%, return on invested capital about 28%. The biggest worry, though, for this name is the exposure to China. And we know that China's property market is struggling, continues to struggle despite the government trying to stimulate their economy. They're mainly focusing on the export sector. And the worry is that AOS will get caught up in that property crash, shall we say. What kind of exposure are you seeing, Luke, and are you seeing anything else?
I agree with you. I think that's my primary concern as well. It looks like about 22% of their revenue historically has come from China. I mean, that's a pretty significant chunk, the rest of which primarily comes from North America. And even with that in mind, right, it's still trading at a forward-looking price to earnings of about 20. Its price to book value about 6.4, both of which are well above their 5-year average range. So it's still a little bit expensive, even with the risk of that Chinese revenue drying up. So for me, given where it's priced at right now, I'd probably have to pass.
Yeah, I mean, it just depends on what metric you're looking at. Enterprise value is around 14, which is slightly below the 5-year median of 15. So, based on that, you'd say it's about fairly valued. It's a good company. I just worry too much about 22% of their revenue coming from a market that is so that is struggling so mightily, and so it is at support. I will say that, but not great support. I don't think we're quite there to say, okay, this is a great buying opportunity. I would need this to get back to around $76 per share. Now we're at 82. That would be major support. Thanks for the call. Now, Luke, let's talk about the broader economy. We have the jobs number on Friday. We had the ADP number came out today. That was slightly disappointing. And there have been some economic data points lately that show that the consumer is getting weaker. The first one was the personal consumption expenditure report for the month of April. And then most recently, you have some jobs data. Yesterday, you had the JOLTS data, Job Opening and Labor Turnover Survey. That's JOLTS. And that fell by about 4%. And that brought the ratio of unemployed people to jobs opened to about 1.24, which, for context, brings you right back in line with where we were pre-pandemic. So I think the question is, Luke, are we getting enough data to say that, are we heading to a recession, or is just this a continuation of normalization?
Yeah, I think that's a difficult question, right? As you hear the headlines, which are labor market softening, wage growth falling off, consumers spending less. But then you have to think about where we have been over the past 2 years, coming out of a pandemic where savings were historically high, where the labor market has been incredibly tight, even in spite of a rise in interest rates over the past year and a half, 2 years at this point. And so from my perspective, yes, you're seeing this softening. Yes, you're seeing growth trimming down a little bit. But what you're not really seeing is more wider spread unemployment. You're not really seeing businesses cutting back on CapEx as much as you'd expect in anticipation of a downturn. And for me, those signs, as well as where credit spreads are, which they're not as you would expect them to be if there was a recession on the horizon as well. So those are better indicators of forward-looking things rather than those relative comparisons to where you've been over the past year in a time that is unlike any other time, at least in our lifetimes.
Yeah, typically you do see, if you're going to get some sort of a recession or a major wave of layoffs, you typically see the credit markets start to signal that, and we're not getting that at all. And there are multiple ways to look at this news. One is to say, hey, a little bit weaker labor market is not such a bad thing, because that will put lower pressure on inflation, right? Wage inflation, and it will allow the Fed to become more dovish, more accommodative. And so that's one way to look at it. The other is the more negative viewpoint, which a lot of people, kind of skip to and they try to prognosticate, which is that once job openings get low enough, the unemployment rate will actually start to rise, and companies will start to lay off, which is, like you said, not really happening. Now, so on the flip side, though, they're also not really hiring either. Okay, and so the hiring rate is at even below the pre-pandemic levels. So from that perspective, that's kind of an issue. It's hard to create jobs and sustain a reasonable jobs number when companies continue to be hesitant to hire. It's like they don't want to fire, but they also really don't want to hire at this point. Now, historically, the ratio of job openings to employment When it gets below about 4.5%, that's when things get a little dicey. Right now, it peaked at about 8% when there were so many job openings in the spring of 2022. Now it's at 5.1, but once again, it's falling. So that's something to continue to watch. Retail sales in April, that was choppy, flat, nothing really much to take out of that. The GDP number as of late has been kind of around longer-term trend growth, 1.5%, 2%. So that's not really telling you a whole lot. ISM manufacturing, that came out on Monday. That was not good. The new orders certainly was weak. So you're getting economic data that is telling you, yes, we're downshifting a bit. But just because you're downshifting doesn't mean that you are headed for an economic stop. And there are not a lot of indicators that are telling you that is the case either. So now, as you might imagine, the news that we lost our dear friend Steve Peasley has affected a lot of our listeners. So we want to read several comments that were posted via the YouTube channel. GSG2 says, we will miss you, Steve. I'm keeping the InvestTalk family in my thoughts. Thank you for that. Richard Lombardo says, always loved listening to Steve. He will truly be missed by many. My deepest condolences to all of his loved ones. I'll definitely pass that along to Suzanne and his family. Jeremy Meyer says, Justin, Monday must have been your toughest episode. This is sad news. I've been listening for about 10 years. Be strong for Steve. He'd be very proud of you and thankful for the show. Thankful that the show carries on. He will want us to continue to learn. Steve definitely had a heat for his listeners and will be missed. And definitely will be missed. And it was a tough show, but I'm glad we're able to do it and honor him. Todd Turner says, I'm sorry. Steve was a great man. He would call me when I sent through a question to InvestTalk. I told him I felt like I was talking to a celebrity, and he laughed at that. We chatted on European history for a bit, and he helped me with my investment questions. I miss hearing his voice. Yeah, I get the same feedback from a lot of our listeners when we do portfolio reviews. But yeah, Steve was a great man. He did love history, loved reading. And I think we all miss hearing his voice. Luckily, we still have archives of hundreds of InvestTalk episodes to go back and listen to. And then Samal says, I'm saddened to hear about Steve. I always enjoyed listening to Steve and his sense of humor while giving real good financial advice. I will never forget his line, always buy profitable businesses and don't buy companies that don't make money. Steve will be sorely missed. My heartfelt condolences to Steve and the InvestTalk family. And thank you all who reached out via email as well as the YouTube comments. And we thank everyone for your support and missing Steve. Let's play another caller question now from 888-99-CHART.
Hey, Justin and Luke. It's John from Georgia. I'm just calling today to get your thoughts on Matador Resources. Ticker is MTDR. Everything I look at looks pretty good, but my only concern is that it looks like they continue to issue shares. I'm just wondering, is that something to be concerned about? Is it a good buy? Thank you.
Are looking at Matador Resources. They are an E&P company in the areas of Texas and Louisiana. Earnings are up and down as you would expect from an E&P company. They're a price taker, and where oil and gas move, that's what price they're going to get for their products. Now, this is a $7 billion market cap, so kind of a mid-cap name. It's been pulling back lately, but all of the oil names have because oil prices have come down. It looks like it's performing about even with the overall sector as a whole. But what are you seeing, Luke? Anything jumping out on the debt level, on the profitability, et cetera?
Nothing really jumping out. It looks like they've steadily improved their cash flow over the past couple years. Profitability, again, is variable, and as you mentioned, why. Debt levels are not too bad, $2.2 billion on a $7 billion company. Their dividend yield seems to be pretty consistent in terms of the dividend they're paying out. Actually, it's been improving. Take that back. It's been improving. It was 13 cents a share, then 30 cents a share, then 65, supposed to be 85 cents a share this year. So that's certainly headed in the right direction as well. There's a lot of short interest out there. It's about 8% short interest, and frankly, there's a lot of volume as well, so that's a good thing. They've issued some shares. Looks like they issued 5 million shares So
Yeah.
just under about 4.5% of the company this year. Nothing that's really striking me that is separating it from the pack, to be honest.
Yeah, exactly. This is a fine name. I don't like that they had to issue shares. That doesn't really make sense considering their cash flow levels, their profitability at the moment. But as you said, their profitability is pretty up and down. And I would like one that's a bit more consistent. And I think you just could find a better name within the space. It's fine, but I agree that the share issuance is something that I don't love. Now let's talk a little bit about the dollar, Luke. The dollar has been pretty strong as of late. And historically, that brings about a weaker economic environment going forward globally. But you might start to see some weakness in the dollar, and especially if you have a new Trump administration, right? He's talked many times, and his economic advisors advocated for a weak dollar. So that's something to think about as we head into the election. But also, when the dollar has been this strong in the past, there have been things like the end of the gold convertibility back in the early 70s. And you also had the Plaza Accord in 1985, where multiple large countries got together and they were worried about the effect of the strong dollar on the manufacturing sector. And that's something absolutely to be worried about, and especially as both administrations are trying to onshore a lot of manufacturing. It just becomes more difficult to do that when domestic labor and production is just more expensive. And so in 1985, Britain, Germany, France, and Japan, along with the U.S., got together at the Plaza Hotel in New York City. So they call it the Plaza Accords. And by 1988, the U.S. dollar lost a third of its real value. So, Luke, is this saying that maybe the governments are going to, whether that is the Biden administration or Trump administration or whoever wins the election, is going to think about doing the same thing as the Plaza Accords?
Potentially. I think there's also some external factor going on here. So you think about coming out of the pandemic, you had outsized growth in the U.S. and outsized the taming of inflation relative to the rest of the developed world. And so historically, you've seen the dollar be stronger when growth in the U.S. has far outpaced Eurozone growth, Asian growth. Now, coming out of the pandemic, that was the case, right? So going forward, should inflation be tamped down in other countries, you see growth pick up in the Eurozone, growth pick up in Asia, growth pick up in other countries, that could also naturally weaken the dollar. And so it's important for you to keep that in mind, because historically speaking, as the dollars become weaker, that's when international markets tend to perform better. And so you've seen U.S. stocks with a strong dollar, even this time around, have been performing way better than international stocks. And so those are just some of the dynamics that go on, and certainly how it can inform how you want to allocate your portfolio going forward.
And typically when a central bank, this applies to any country, but typically a central bank is raising rates and the fiscal authorities are spending, that typically is good for the dollar, because the economy in the near term gets strong, and then the rate differential also improves typically. And so now you actually could see the opposite. We just talked about, hey, the Fed might be cutting rates sometime, probably Q3. And then if you look at the fiscal impulse, as we go to the back half of the year, the fiscal impulse actually turns slightly negative, because there hasn't been a whole lot of since the Inflation Reduction Act, there hasn't been a whole lot of new stimulus coming on board. And so I think you definitely could see the dollar weaken, and that would bring a tailwind to those overseas stocks, like you talked about, Luke. And so that's one reason why you might want to be a bit overweight those foreign names at the current time. And it'll be and from an industrial policy standpoint, I think both sides want to work on that, and a weaker dollar would be beneficial for their end goals. So I think you might see a weaker dollar going forward. Now we're quickly getting closer to Tuesday. That's the day where we have our new online wealth webinar. Quality investing, digging deeper than dividends. Head over to investtalk.com and register now. But give us a call now at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit investtalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to investtalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Hey, good afternoon, gentlemen. Got a question about conversion of a Roth 401k to a Roth IRA after separation of employment. I've got about $700,000 in a Roth 401k that I had converted to brokerage link, still all Roth. I separated employment and had the option to move it to my Roth IRA. I couldn't move it like in kind. They would have to liquidate everything and then move it as cash, and then I would have to reinvest it. So my question is there an advantage to that? Is there added risk to that? Right now in the brokerage link, even though it's a Roth 401k legally, I can't take out the contributions without a penalty. But somehow if I convert it to my Roth IRA and I needed to do so in a pinch, then the Roth IRA rules apply. Look forward to hearing your thoughts. Thanks. Bye-bye.
Well, you just talked about the pros of moving that over to a Roth IRA. You know, if it's in a brokerage link, hopefully you can buy whatever you want. Most brokerage links you can, and therefore there might not be a big upside to that. Now, I don't know what the brokerage link is through. Most 401ks, they have, you know, their standard suite of investment options, mutual funds, and then some of them are allowed to opt some of that money or all of that money into a brokerage link, and that's typically at Fidelity or Schwab or E-Trade, one of the big brokers. Now, the good thing is the current situation is you're locked into whatever broker that is, and that might be one you like, it might be one you don't like. And rolling into a Roth IRA allows you to open that Roth IRA anywhere. Now, like you said, you have to liquidate it, and that's going to be a process, and that typically takes, a week to 2 weeks to get that money moved. And who knows where the market is? Might be beneficial. You might do it at a time when the market's down, and you can rebuy things at a lower price. That's the risk. Is that it goes the other way though, which is the market goes up and you miss out on some gains. Typically, I would say do it. But only if you have a broker that you think would be much better, and you think you'd tap into that money at some point in the near future. Now let's talk lastly, Luke, about private equity and the healthcare space. And it's pretty interesting. There are some new state and federal regulators looking at the actions of some private equity companies that have been trying to buy up healthcare providers in a particular region. And this has really pushed up prices in healthcare. Private equity typically talks about more competition, lowering prices, et cetera. But what they're doing is they're buying up the doctor's offices that have the same type of practice in a particular region, and they're charging the highest price possible for that, and it doesn't give the citizens of that area a lot of options. So is this a sign that the private equity running roughshod over our economy is coming to an end, and do you think the FTC will stop it?
Well, I think this is one of the issues where, especially in a time where we've been doing so much to try and tame inflation, one of the largest sources of pain and cost growth for consumers is healthcare. And that's kind of indicative of this country relative to other countries as well. And so when you have a situation where it's as clear cut as you're stymieing price competition and you're fixing prices to harm consumers, certainly this is exactly where the FTC and the DOJ would want to step in and make sure that that is not happening. You know, you think about historically how antitrust, anti-monopoly laws have been in place and how that doesn't really apply to how we perceive tech companies these days, right? Because they're not really buying up their competition. They're monopolizing an area and doing it in a way that we didn't really know how to combat. This is the exact opposite, right? This is buying up all of the competition and fixing prices. This seems to be the most clear-cut case that the FTC and the DOJ would want to go after.
Yeah. And I know this fairly well because my fiance, she's a dermatologist, and you know, there are only so many. I think there's only a few thousand dermatologists in the entire country because I think there's only a handful of residency programs, and only 2 or 3 come out of residency each program each year. So there's just not a lot, and that's the same with a lot of different disciplines. And so if you're able to really control that supply of talent within a region, you can squeeze those that need those services badly for a lot of money, and that's what private equity has been doing as of late. And I think you're going to start to see the regulators crack down on that. Now, I'm Justin Klein here with Luke Guerrero. This concludes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And I hope that you've heard that the InvestTalk podcast is also in video form over on our YouTube channel. Just head over there and search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.